For years, the silver market has been presented as orderly, liquid, and well-supplied, governed by futures exchanges that supposedly balance price discovery with physical availability. That illusion is now cracking. What we are witnessing today is not a routine cycle, not a speculative spike, and not a temporary dislocation caused by macro noise. This is structural stress surfacing in hard data, in delivery behavior, and in inventory withdrawals that no longer align with the story Western markets have told investors for decades. Something fundamental has changed beneath the surface of the COMEX silver market. Contracts that were once rolled, netted, or cash settled are now being converted into physical demands at a pace that defies historical norms. Month after month, year after year, participants are no longer treating futures as paper instruments. They are demanding metal, immediately, aggressively, and without delay. That shift alone should command attention, because it signals a breakdown in confidence in the system itself. Today's analysis centers on one of the most rigorous and data-driven voices in the precious metals space, Clive Thompson. Thompson is not a commentator chasing price targets or sentiment swings. He is a numbers man focused on delivery statistics, inventory flows, and the internal mechanics of futures markets. What his work reveals is deeply uncomfortable for anyone who still believes silver pricing is under control. In the first part of this video, we'll examine Thompson's breakdown of COMEX deliveries and why the mathematics for March simply do not work. Then, we'll go further, connecting the dots he doesn't explicitly spell out on camera, especially the extraordinary February delivery behavior that exposes a market no longer functioning as a futures exchange at all. Stay with me, because by the end of this analysis, it becomes very hard to argue that silver pricing remains contained, managed, or sustainable.
Today, I'm going to be talking about the silver crunch, which I think has a high probability of happening in the month of March or late February. Let me talk about it. In exactly 3 weeks, on February 27th, the COMEX silver market faces its first day for March delivery. And what I'm about to show you suggests that we may be witnessing a systematic draining of physical silver from the world's primary futures exchange. I'm going to walk you through the official CME delivery data that reveals what could be an accelerating crisis. I'll look at the numbers month by month, year by year, and show you why the mathematics simply don't seem to work for March. Now, this is maybe a little bit of speculation, but it looks to me like there is a crunch coming. And this comes from the hard data from COMEX itself. And the story it's telling me seems to be extraordinary. Let's start with the big picture, and we'll look at what happened across the entire year of 2025 compared with 2024. So at the top here, you see the number of contracts for 2024. So we're going up here. There we are. There's the number of contracts for 2024 at the top, and there's the number of contracts for 2025, where my mouse is. And I've translated that into ounces of silver, so I've multiplied each contract by 5,000 to get to the number of ounces represented by each contract. So down here, we see the number of ounces which were called for delivery in 2024, and next to it, we see the number of ounces called for delivery in 2025. And we can see that every single month, without exception, the number of ounces called for delivery on the futures contracts were significantly higher in 2025 than 2024. And if we look at the bottom line, this line here we see it, we can see that the number of contracts in 2025 were more than double, well over double, the number delivered in 2024. So total silver delivered in COMEX in 2024 was 202.7 million ounces. Total silver delivered through COMEX in 2025 was 474.4 million ounces. That's 2.34 times higher in 2025 than 2024. More than double. But what's this telling us? This wasn't just 1 or 2 months driving this increase. Every single month in 2025 saw higher deliveries than the same month in 2024. So, for example, we have January 2025 saw 11.85 million ounces compared with 6.8, February 23.94 versus 6.54, March 80.75 compared with 27.43, and so on. And you can see that all the way through the year and right on through to December. So these higher deliveries were not a one-off event. What this is telling me is there's been a systematic shift in how market participants are using the COMEX. Instead of using it as a sort of hedging mechanism to roll over their contracts month by month, they're increasingly demanding physical delivery rather than rolling their contracts forward and settling in cash. So something has changed in 2025. Now let's zoom in on January, where things get really extraordinary. So I'll scroll to here, and here we're looking at the figures for January. So let's look at the 3-year progression. January 2024, 6.8 million ounces. January 2025, 11.8 million ounces. January 26, 49.4 million ounces. So we've gone from 6.8 million in 24 to 49.4 million ounces called for delivery in January this year. Now, January is not a major month. It's normally a minor month. The major months we can see, if we go back to the chart here, we can see the major months are March, May, September, and December. So it's not a major month. Normally January is a minor month, but we've had this record number of deliveries in the month of January. Why does this matter? Because this level of delivery in a minor month tells you that market participants are starting to front run what's going on. They're not waiting for the major delivery months. They're not sure they're going to get their delivery in March, and I'll show you why in a minute. So what are they doing? They're rushing to take delivery in January just in case they can't get it in March. They're not waiting for the major month. They're taking metal now in January, even though March is just 3 weeks away. And March is traditionally the major delivery month. We can see that by going back again to last year's numbers. There we are, March. If we look at March, that's the highest delivery month, 16,000 contracts or 80.7 million ounces last year, up from 27 million the year before. 80 million ounces last year.
What Thompson described next in his video may be the most important revelation of all. February 2026 is not merely another strong delivery month. It is a statistical anomaly so extreme that it effectively redefines what the COMEX market is doing. As of February 4th, just 4 days into the month, 18.72 million ounces had already been delivered, nearly matching the entire month of February 2025. But the real shock lies in the open interest behavior. On January 9th, total February open interest stood at 19.1 million ounces. Within days, almost all of it was called for delivery. That implies a 98% delivery rate, a figure that simply does not exist in a functioning futures market. Under normal conditions, only 5 to 10% of open interest stands for delivery. Even under stress, 15 to 20% is considered extreme. 98% is not stress, it is transformation. At that point, COMEX is no longer acting as a futures exchange. It has become a physical allocation mechanism, where nearly every contract represents a demand for metal rather than exposure to price. That distinction matters enormously. Futures markets rely on leverage, netting, and rollover behavior to function. When participants abandon those mechanisms en masse, the system loses its elasticity. It becomes brittle. The remaining open interest after February deliveries is barely 4.17 million ounces, and as Thompson correctly notes, that metal is almost certainly already spoken for. This delivery intensity is unprecedented. It confirms that participants are not speculating on price, they are securing supply. And when sophisticated actors behave this way, It usually means they see constraints ahead that the public market has not yet priced in. With that context established, Thompson turns to March, and this is where the mathematics collapse.
Now let's go to March. Look at the month of March. March 2024, 27 million ounces delivered. March 2025, 80 million ounces delivered. That's 2.94 times as much. It's a tripling, 3 times as much if you like, year over year. And March 2025 was clearly a stressed market. Now, as of today, February the 4th, 2026, that's 2-3 days ago actually, which is the last figure available, here's the open interest for March. March's open interest is currently 429 million ounces. We see the figure here, 429. It's down from 508 million ounces in January, on January the 9th, and some of that has been rolled forward to the May contract, and some of it was rolled backwards, if you like, or forwards, depending which way you look at it, to the January contract and delivered in January. But people were clearly taking delivery in January by moving their contract from March to January to get their hands on the silver, because they're not sure they're going to get it in March. Now, not all of this 429 million ounces here will stand for delivery. Some of it will roll forward, but a significant percentage might be called for delivery based on what I see. So, yes, there were 79 million ounces decline between January 9th and February the 4th on the futures contracts based on the number of open interest contracts. So where did that 79 million go? Well, remember, in January or February, some of it was taken delivery in January or February. Let's call it 49 million ounces in January. There we are. And some of it rolled forward to May. We see the May contract going up from 105 million ounces to 132 million ounces. So May effectively increased by 27.5 million ounces. So contracts are doing one of 3 things. They're taking delivery now, the January spike, closing out entirely, or rolling forward to May. But we still have 429 million ounces remaining for March. If March 2026 simply matches the March 2025 number, that's $80.75 million ounces will be called for delivery, which will be 1.5 times what December 25 delivered. I would say that's the absolute minimum we could expect. Let's say we have 25% of these 429 million ounces coming to delivery. That's 107 million ounces will be called for delivery here in March. But I'm being very conservative if I say only 25% will be called for delivery. I'm kind of saying, if that were true, that 75% of the contracts will either roll forward or close, and only 25% take delivery. Given that February saw 98% delivery, this seems optimistic. So I'm going to move forward to a more moderate stress level of 50% delivery rate, so 429 million ounces of futures contracts, and we have roughly 214 million delivered. That's half the contract staying for delivery. And let's say we, in a high-stress market, which it looks like it might well be like that, we have 70% delivery rate, well, then we're looking at 300 million ounces. 300 million ounces will be called for delivery in March. Now I'm going to show you why that's a problem. Let me click to the next slide. Here, you see the COMEX registered silver inventory over the past few months. In October 2025, we had 167 million available. By January 9th, 123 million. By 22nd of January, 114 million. And now, only 103 million ounces. In just over 3 months, the COMEX registered silver has fallen from 167 million ounces to 103 million ounces. That's a loss of 64.2 million ounces, or a 38% decline in the 3 months. A significant percentage of COMEX silver has just gone in 3 months. And the pace is accelerating. In just the last 26 days, 20.4 million ounces went out of the registered section. Now, the registered section is what can be delivered to meet the futures contracts. So we've got 785,000 ounces draining per day. So if that continues, by the time the March delivery begins on the 27th of February, that's in 23 days' time, we'll have a drain of another 18.1 million ounces, leaving only 85.4 million ounces when March delivery begins. Now let's once again refresh our minds on the scenario. March 2025, 80.75 million ounces were delivered. We'll just go back, look at that figure again. There we are, 80.745 were delivered, or let's call it 80 million ounces were delivered. But if we get to a conservative approach that only 25% of these contracts are delivered, over 100 million ounces demanded against an inventory of probably 80 million, we will have a shortfall of 21.9 million ounces, and that's in a very conservative estimate, no stress at all. But if we have a high stress market, which is the way it looks like it's going, where 70% of these futures contracts are called for delivery, we will basically see 300 million ounces being called for delivery when there's only 103 million, which will drop, by the way it looks, the way it's going, down to about 80 million ounces. We'll be short by 215 million ounces of silver in March. The maths doesn't work.
What Clive Thompson's analysis makes painfully clear is that silver is no longer behaving like a controlled, paper-dominated market. The delivery behavior we are seeing signals a loss of confidence in future availability, not just in price. That distinction is everything. Price suppression mechanisms rely on trust. Trust that metal can be sourced when needed, and trust that paper claims remain credible. That trust is eroding. When futures markets shift from leverage-based trading to near-total physical allocation, control breaks down. The Western pricing engine has always depended on the assumption that most participants will never ask for metal. Once that assumption fails, price becomes subordinate to availability. And availability, as the data shows, is tightening rapidly. This does not guarantee an orderly repricing. In fact, history suggests the opposite. Markets that lose physical control rarely adjust smoothly. They gap, they freeze, or they reset violently. Silver's unique dual role, monetary metal and industrial input, only amplifies the risk. A shortage here does not stay contained to one exchange or one country. If this analysis resonated with you, stay with the channel. Clive Thompson's work deserves careful attention, and the coming weeks may prove decisive for the silver market as a whole. Thank you for watching, and if you value deep, data-driven analysis over noise and narrative, make sure to smash the like button, subscribe, share this with fellow investors, and stay prepared, because the math, this time, is unforgiving. Thanks for watching.